Hey, this is Trader Travis, and I have a weekly market commentary for you, as well as I want to review a trade that John, the fireman, submitted for me to review. So what I want to do first is go over the general market. I'll also touch on some of my current trades I have open and another trade I recently opened here. So let me first give you my thoughts on the general market. The general market so far this year it started off flat, went sideways for a little bit, then had a nice short jump up in price, and then has gone flat again. And I was telling myself over the weekend that if the general market, S&P 500 and Dow, NASDAQ were up today, then I would consider this short-term pullback in prices to be over and that the trend upward most likely would resume. But today was a small down day, so I am cautiously optimistic now. So I'm mainly neutral bullish, meaning that I'm mainly neutral, evaluating where prices are actually doing. I don't believe in predicting the market, but I'm still bullish overall because the 200-day moving average, or the yearly average here, is up. So stocks over the long haul, over the last year or so, have actually been up. So that gives me my long-term perspective of being bullish, but in the short term, I'm pretty much neutral based on what prices are actually doing. And so in my short-term account, the one I model for Market Club shows down about $100. And there's only one opportunity this year I've really been able to trade that, and that's during this short run up here in prices. And of course, during this short run up in prices, that only stocks I pick were the ones that didn't perform that well. So now I'm sitting tight and waiting for a better opportunity to trade, pretty much waiting for the market to start trending again. Interesting thing about the NASDAQ is the NASDAQ looks a lot better. The NASDAQ has actually been trending a lot better. It traded sideways a little bit recently, and then prices started going up. So out of all three, the Dow, NASDAQ, and S&P, the NASDAQ is actually the ones looking a little bit better. They all trade and trend somewhat the same, neck and neck. So what one is doing, the other usually follows suits. So I don't know if this is a case where the NASDAQ is leading the way and the NASDAQ is projecting to us what the S&P and Dow should do, in the next coming weeks, is go up. I hope that's the case so I can start trading again, but I'm not entirely sure. Again, I don't believe in predicting the market. I just evaluate the market and then trade according to that. I trade what I see, not what I think I'm going to see, is how I usually say it. And right now, what I see is a market that's kind of stagnant and not producing all-time new highs, which just means I'm sitting on my hands and I'm not really opening any new trades until I can get a decent gauge on the general market. Maybe somebody else could open some trades that benefit from the stagnant movement, and that's a possibility. But for me, it's not, because I already have several trades open in my long-term account and my risk is maxed out. So my longer-term account, the bigger account, current trades are up about $2,200, and today alone they lost about $400. So all these trades right here pretty much maxes out my risk I'm willing to take in that account. Even though it's profitable, I'm sitting tight, because if I try to force more trades, that'll take me over the risk. And what I mean by the risk is I always set it up so that the majority of my account is in cash. I only have a little bit out at any one given time, and that works for me, and that still allows me to earn anywhere from 2 to 5% on my money each month. So that's the manual way of kind of looking at the general market. Another way, if you use Market Club, is you could come here and you could simply go to top options for those who are a member of Market Club options, and it kind of gives you up here at the top as well as the bottom of all these stocks right here. These are all the stocks that satisfy the Market Club options blueprint. But all I do is come here up at the top, and it gives you the score, the trend scores here. Same thing we saw manually, and this is the beauty here. People always say, well, should I use software? It's like, it really doesn't matter. It tells you the same thing that you can learn manually. It's just that it gives you a helping hand up when I've been doing this for over 15 years. So yeah, I can manually look at the chart and kind of read what prices are actually doing and what I think they may do in the future. But the software will tell you the same thing, but it just helps you a little bit more if you don't have that confidence or that experience at reading stock charts for years. So we can see the same thing. The NASDAQ has plus 85. That's a better trend score than these other ones, negative 60. And the NASDAQ recently triggered for a weekly trade triangle. So we can open up the chart here and we can see that it pretty much triggered for a new weekly, which means that in the next coming weeks, it's signaling that prices will go up here. And so all three trade triangles are they're all green except this one red daily here. So we would be waiting for a green daily, and then we'd have all green on the NASDAQ. But again, this NASDAQ is the only one out of those three that triggered a weekly. So maybe it's telling us that the S&P and Dow is right behind it. I don't know. Again, I don't believe in predicting. I'm just monitoring what's going on, and I try to get in alignment with it. And a practical way of explaining that is if the market is going up like it did here, I don't predict that it's going to fall. I don't predict that it's going to keep going up. I see that it's going up, and I trade strategies that benefit from it going up. That's it. When it starts going sideways, then either I sit on my hands or I start trading strategies that benefit from it going sideways. And that is how I dance with the market. I consider it dancing with the market. You want to do with your partners doing. I don't try to do the opposite of what my partner is doing. I evaluate what my dance partner is doing, and I get in alignment with it. In my opinion and in my experience, that has led to more profit overall than the whole let me be a contrarian trader and let me predict things and go the opposite direction. That may work for some people. It just doesn't work for me. All right, so now let's go ahead and review this trades that John opened up here. So John opened up AT&T here, bought a call option back when the market was going up 317. We can look back here at the chart. We can see around 317 is actually the market was going flat at that time, but it still had not fell in price. So it was going flat. So I don't know if John used Market Club or what kind of template John used. He didn't say. But at that time he placed a trade, it was pretty much right around the high, right before the market started pulling back in price. So not the optimal time to place a trade, but guess what? John couldn't predict the future. He didn't know the market was going to fall in price. So he just traded what he saw. It wound up being a small loss here. So so I don't know if John was using a percent loss exit, invested 200, lost about 100. So that's about a 50% exit, give or take. So if John was using Market Club, I actually have that pulled up. I would have actually, where is it at? Tesla's a stock I just opened. Okay, so Market Club actually triggered for red weekly on 322, and John exited his trades on 328. So if you use Market Club, John, I do not mess with weekly trade triangles, meaning that I don't ignore them. If a weekly gave me an exit, I exit. That trumps my 50% loss exit. But again, based on my experience using the trade triangles, the weeklies are fairly accurate enough to make money. We can look here, weekly went down, then it went back up. This signal that was going up, it didn't go up. So right now, AT&T is kind of stagnant. We don't need the trade triangles to tell us that. Let's pull up an actual chart. So what I want to do is go back and forth between manually looking at stuff without the aid of software and then going back to the software. So you can see that it pretty much shows you the same thing. It's just a different way of looking at the same thing. So we can look at a 9-month chart of AT&T, and what has it gone and done in 9 months? Nothing. We look at the beginning of the period, the end of the period, nothing. It doesn't matter what happens in between. It has a lot of action like a soap opera, but at the end, nothing has really gone on. Okay, AT&T started going sideways about here at the beginning of the year. So it's actually been flat all year long. If we pull up, then we can scale out, look at a 1-year chart. Still, it only went up a little bit, but it's been flat since July 2016. And then we come out to a 2-year chart to get a bigger picture. Okay, 2-year has a nice chart, but again, looking here, you can see it pretty much has been trading flat or trading right around resistance around July 2016. Resistance, for those who don't know about it, it's things that stock traders use. They consider the price barrier, something that's holding prices back. It's just an imaginary line or a price point. The resistance is not this line I drew, it's just a price area. So around this price area, the stock has had trouble going past it. And so it pulled back, came up, tested resistance again, and it's been teetering around resistance. So John opened a call option trade. A call option trade on a stock that's going sideways is not a good idea. Call options are highly volatile, highly sensitive to price movement. So you absolutely need the stock to move. And so that's something you want to pay attention to. If the stock is having trouble passing resistance, if you want to open a call option trade on this stock in the future, I would just wait until it proceeds past its price area, preferably on higher volume. So real quick, I'm just going to take a peek at CVS. CVS is going down. I don't know why would you would trade a bearish stock going down when the market is going up. Goes against the templates we teach unless it's just a speculative trade for you. But with that being said, it looks like you're in profitable territory. All right, so let me come back here to AT&T. Okay, so let's now look at Market Club, and then I'll tell you what would be a decent strategy for this stock here. So let's come to AT&T on Market Club, so we can pretty much see almost the same thing. In Market Club's help menu, which I always encourage everybody who has the software to use, they will tell you that the trade triangles will be produced regardless, right? Just because a trade triangle is on the chart doesn't mean you should trade it. You always want to still look at prices, which is why I always encourage students to look at a naked chart. Just don't get seduced by the trade triangles. When you look at a naked chart, you will be able to see that AT&T is trading sideways. It has some trouble around this particular price area. And that's exactly what you see on the trade triangles. That's why you have these mini weeklies. It's a weekly trade triangle. They shouldn't come that often. If we come out to a 2-year chart and then put on the weeklies, look back here at the beginning of the chart and how often or not often the weeklies came, okay? Now, then we scale back and now we look here, they're coming back to back. It shows stagnation. Schizophrenia is what I call it. So even the trade triangles are showing the same thing that we can see manually. Now, so I pretty much not trade directionally on this until I can see the stock passes this price area. But with that being said, there are strategies you can trade on it, and they are called income strategies, where you're selling time. And a good price point for that is if you know this stock has had trouble preceding this area, just kind of look at where support and resistance are. Support will be the opposite of resistance. Support is kind of a price area that's holding stocks above it. So we can look here around the 40, 41, right around here. So you could take a selling strategy. You could sell it some options around this price level, or if you want to be a little bit more conservative, you can come up under it around the $40 price level. So one of those strategies would be like an assurance trade, also called verticals, or vertical spreads, so vertical credit spreads. So that's something you could possibly trade on AT&T manually. This is how you would evaluate it. Manually, you're just looking at support and resistance and things like that. All right, so that's what we're looking at here. One last point here. I won't look at this next trade here because it's already closed out. You made a credit spread on Google. I do want to point out one thing. I think I know what you meant, but I want to make sure. You said you tried a bullish credit spread on Google. So Google actually looks like it's going up in the next few days. Had a short pullback in price, but it looks like the trend is resuming. We won't know for sure until it gets past resistance here, but it looks fairly healthy. It looks like it's picking up. The general market was down today and it was up 1%. So it's trending stronger than the general market right now, but we won't know for sure until it gets here to resistance and if it goes past it. But you put here that the trade expired with a $400 profit. Congrats there. But you said you bought these options. And if you did a vertical credit spread, that will be selling options. So I think I knew what you meant just because you said expired worthless. If you bought options, they wouldn't expire worthless. They not expire worthless. They wouldn't expire with a profit. You expired. And when you buy options, if they were profitable, you get expired, you get assigned. So you wouldn't really have a profit. They would expire and you'd own some stock shares. Now, if you sold a credit spread, then yes, they would expire worthless and you'd hit a $400 profit. But you put bought here. And again, I think I know what you meant just because you told us that here you did a vertical credit spread. So that tells me that you sold a set of options. But I'm pointing it out here because you want to get this clear even in your writing. Because sometimes if you're thinking one thing, you write another. Sometimes what you write could actually be what you do. So when you place these trades, I don't want you thinking anywhere in your mind, your vocabulary, your fingers as you're typing. I don't want bought anywhere in your vocabulary because I don't want you to make the mistake of thinking you want to come in and sell options, but you mistakenly buy options. So you want to make that clear, both what you're doing, both what you're thinking, and both what you're typing, and that will avoid mistakes in the future. And I'm saying that because I've done that too in the past. The only thing that's helped me out is TD Ameritrade. It's easy for me to tell when I'm selling something versus buying, because when I'm selling something, cash shows up in my account, it shows red. When I'm buying something, it shows green. Cash leaves my account. So that is what always has helped me out, is to train myself on colors. Because I've made that mistake before, where I wanted to buy something and I accidentally sold it, or vice versa. I wanted to sell something and I accidentally bought it. So I said, I need to find a way to prevent this from happening in the future. And that's how I did it. I just trained myself to look at the colors. Now, every platform is different. So not all platforms has that thing in there. But that's one of the things I appreciate about my platform. It has those little quirks like that helps me out. And last point here, you don't know if weeklies are a good place to start. I would say no. For newer traders, weeklies, man, they're like the wild, wild west. Weeklies are options that expire in a few days, few weeks, things like that. So all of these are weeklies, the ones that have short expiration dates, the ones that are in yellow, the ones that are the regular old school options that I started with the regular expiration months, are the ones that are not yellow. Those are the ones I started with. Those are the ones I recommend newer traders start with. The weeklies can be very volatile. They can be very profitable. You make your money really quick. The downfall is they give little to no room for error, because there's no time for the stock to recover, like Google. Let's say you place a weekly credit spread at Google right here, right before it started pulling back in price. Well, when it pulls back, you don't have any time for it to recover. You just lose all your money. But you can see here the stock is recovering, is actually going back up. So the regular dated people who traded the regular dated options here bought themselves, more time for the stock to do what it needs to do, versus the weeklies. It's, hit or miss, so that's why I don't recommend newer traders start there, because you can rack up a lot of losses pretty quick, and you rack up your lack of self-confidence pretty quick. So every week you're getting your emotions beat up as a newer trader. So I'd say just stay with the regular dated options until you get a rhythm, until you have consistent success, until you have experience up under your belt. Then maybe you can tackle weeklies. But again, that's my opinion. Feel free to prove me wrong. But I'm always looking for what gives newer traders the highest probability of success. And I have not seen where weeklies does that. So I always advise newer traders to stay away from weeklies. Okay, so now what I want to do is jump to a newer trade I opened here on Tesla based on a Market Club Weekly. Is an income trade. I sold some insurance, and Tesla actually popped up today, and it was actually profitable. So that's a newer trade I opened last week based on this weekly trade chart right here, and based on the general market being up. So I just got lucky. I didn't know Tesla would pop up. I think it was up like, 3% today. So, got lucky there. Not saying, it's a genius. I knew it was up 7% today. So, yeah, I did not expect that. So those trades I opened, and they were actually weeklies. I didn't risk a whole lot. I made sure I just wanted my money quicker. Now, why did I pick weeklies? It's because Tesla has earnings coming up. And so I wanted to make sure that I was out those trades before earnings, because I did not want to carry that trade through earnings. So earnings is coming up here next month. So all of the trades I open expire at the end of April. I think I opened like 4 different trades, and I spread out my risk throughout the option chain. So I think I went all the way up to about April 28th, if I remember correctly. I have those trades not in my TD Ameritrade account. I actually have them in a Fidelity account. All right, so here they are. So let me see, April 7th, April 13th, and then April 21st. So those are the 3 ones I open, and so far they're all profitable because of that big pop here. All right, so that is all I have for you there. I think that's a good note to end it on. You take care, and I'll see you in the next update. All right, bye-bye.